Hey, future millionaires! We have a thought-provoking investment inquiry for you. Within this scenario, there are three investors: A, B, and C. Investor A diligently saves funds in the highest-yielding interest-bearing bank account and strategically deploys these savings during market recessions, seizing the opportunity to invest at the lowest price points during these downturns. Investor B follows a similar strategy, but instead of timing the market to buy at its lowest, he invests at the peak of each recession. Investor C, on the other hand, remains indifferent to market cycles and consistently invests a fixed amount in stocks every month. Now, in the context of long-term returns, which investor do you believe would achieve the most favorable outcome? Pause the video and contemplate whether it might investor A, B, or C. Were you under the impression that investor A, who strategically entered the market at its lowest points during each recession, would yield the highest returns? In fact, it's investor C, who consistently invested a fixed amount each month, would achieve the most substantial returns. This is power of dollar cost averaging. Today, we're diving deep into a strategy that can help you navigate the world of investing with confidence. Dollar cost averaging, DCA. Whether you're aiming to build wealth, save for retirement, or achieve any financial goal, understanding DCA is a must. So, what exactly is dollar cost averaging? It's a systematic investment approach where you invest a fixed amount of money at regular intervals, regardless of market conditions. Instead of trying to time the market, DCA ensures that you're consistently buying investments over time, regardless of whether prices are high or low. What is the goal? To reduce the impact of market volatility and take advantage of the long-term growth potential of your investments. Let's break down how dollar cost averaging works in more detail. First, you'll need to choose the investment you want to DCA into. It could be stocks, bonds, mutual funds, or even a combination of assets. Remember that the suitability of DCA depends on the type of investment. It's commonly used with assets that tend to fluctuate in value, like stocks. Second, decide how much money you want to invest regularly and the frequency of your investments. It could be weekly, monthly, or any schedule that suits you. For example, if you decide to invest $100 every month, that's your fixed investment amount. Third, set a timeline. Determine the length of time you plan to keep this investment strategy. It could be several months, years, or even decades, depending on your financial goals. The longer your time horizon, the more potential there is for your investments to grow. Now that you've seen DCA in action, let's explore its benefits. First, reduces emotional decision-making. DCA helps reduce the emotional roller coaster of investing. Instead of making impulsive decisions based on market fluctuations, you follow a disciplined strategy. Second, eliminates the need for market timing. With DCA, you don't need to worry about trying to time the market perfectly. You invest consistently, no matter what's happening in the financial world. Third, mitigates risk. DCA spreads risk over time. When prices are high, you buy fewer shares, and when prices are low, you buy more shares. This strategy minimizes the impact of market volatility. Fourth, automatic saving and investing. DCA makes investing automatic. It's like setting up a financial autopilot that ensures your money is working for you regularly. Let's illustrate dollar cost averaging with example. Meet Sarah, a smart investor who's ready to build wealth for her future. She decides to invest $200 every month into a diversified stock mutual fund. Sarah begins her DCA journey during a time when the stock market is fluctuating. Some months, the market is up, and other months, it's down. Regardless of market conditions, Sarah sticks to her plan and invests $200 each month. As time goes by, Sarah's investment portfolio starts to grow. Some months, she buys more shares when prices are lower, and other months, she buys fewer shares when prices are higher. Over the years, Sarah's investment portfolio grows steadily, benefiting from both market ups and downs. Like any investment strategy, dollar cost averaging has its criticisms and considerations. First, opportunity cost. Some critics argue that DCA might result in missed opportunities for higher returns, especially during prolonged bull markets. Second, market trends matter. DCA works well when markets are volatile, but it may not be the best strategy during extended bear markets when asset prices steadily decline. In such cases, it's essential to assess whether DCA aligns with your investment goals. Now, let's discuss the drawbacks of lump sum investing. First, market timing risk. With lump sum investing, you're essentially trying to time the market perfectly. If you invest during a market peak, your returns may be impacted negatively. Unfortunately, predicting the best time to invest is challenging, even for the most seasoned investors. Second, potential for regret. Lump sum. Investing can lead to regret if the market experiences a sudden downturn shortly after you invest. This can cause anxiety and second-guessing. Third, all-in. Bet. When you invest a lump sum, you're essentially placing all your financial chips on one bet. If that bet doesn't pay off immediately, you may experience significant losses. Let's discuss when dollar-cost averaging may be an excellent strategy for you. First, when you're uncertain about market timing. DCA is an ideal choice if you're unsure about when to enter the market or if you're concerned about timing the market incorrectly. Second, when you want a disciplined approach. If you prefer a systematic and disciplined approach to investing, DCA can help you stay on track with your financial goals. Third, for long-term investment goals. DCA aligns well with long-term investment goals, such as retirement planning or building wealth over decades. To conclude, in today's video, we've delved deep into dollar-cost averaging. As we wrap up, just remember that DCA is a smart investment strategy that helps you navigate the markets with confidence. 2. By consistently investing a fixed amount of money over time, you reduce the emotional roller coaster of investing and harness the power of compounding. If you found this video helpful, please hit that like button, subscribe for more investment wisdom, and share this video with your fellow investors. Thanks for joining us. Whether you're a beginner or an experienced investor, always remember that the journey to financial success begins with smart choices. Happy investing!